Yeah, so I think the market is effectively getting more concerned about the prospects of a slowdown in the economy. You referenced the JOLTS report. What was more important than just the fact that the job openings fell was the details in that report itself. You know, if you look at job creation in the U.S. and you look at it in the third quarter and the fourth quarter of last year, there was definitely a slowing in non-farm payroll growth, but most of that happened because companies stopped hiring. What's happened in the last 2 months is that trend has shifted away from a lack of hiring, and it's moved towards an increase in layoffs. In fact, the increase in layoffs that we've seen in the economy, judging by the details of the JOLTS report, have probably adding a drag of about negative 200,000 to non-farm payrolls. That's a qualitative change in the labor market in the U.S. that people are inferring when they look at these details. They're getting more concerned about a slowdown in the economy.
And of course, we get that on the heels of ISM manufacturing, which showed another month of contraction. Adam, is this a scenario where bad news is still good news for the market?
Yeah, I mean, I know that was a big topic of conversation in the market today. And my answer is I think it depends. So for the JOLTS report and labor numbers in general, they're still very, very hot. They have a long way to go before they even approach a neutral stance. For the JOLTS in particular, you know, there's still about 2.5 million openings, above where it was pre-pandemic. In the monthly jobs reports, you know, the average of the last 6 months, monthly job creation was over 300,000. A neutral rate is more 100 to 150,000. So the labor markets have a very long way to go before they even approach neutral. So for the JOLTS report today, I thought it was, a clear positive for equities, just given the implications for the Fed and monetary policy. The ISM yesterday was definitely more of a concern. There were the details within that point to a slowdown in growth, and that's definitely something to monitor. But I think for the overall earnings landscape, and this is something we might talk about a little bit later, I think companies have underappreciated tailwinds that they will be able to utilize to offset, reduction in aggregate demand in the U.S.
So then why did the major averages end up trading lower today and breaking those multi-day win streaks? Are we bumping up against technical levels, which we've been talking about the last couple of days? Is it just sort of a lot of uncertainty for investors ahead of whatever the next catalyst is going to be, whether it's another round of data or a jobs report or bank earnings kicking off that season next week? How do you see it?
Yeah, I think definitely, we're in a little bit of a news vacuum right now. The liquidity is relatively thin. I think a lot of people are extremely hesitant. Sentiment is still very negative. And we're kind of waiting for the next round of catalysts. So like you said, the March economic data, got the first one yesterday with the manufacturing ISM. Tomorrow we get the services ISM. I'll be watching very closely. If that's healthy, it would obviously help alleviate some of the concerns from Monday. You get the jobs report on Friday. And then next week, you get the CPI on Wednesday, and then bank earnings, which kick off next Friday. And those are going to be crucial. So I think a little bit is just digesting the recent rally. We've moved a lot in the back half of March, coupled with just a news vacuum, kind of searching for the next catalyst, like you said. My view remains sanguine, for a lot of the same reasons as before. You're seeing a reduction in the monetary tightening overhang. And like I said, I think the key area where I disagree most with the consensus is on earnings, where I think corporate America right now, again, has underappreciated tailwinds that's going to help EPS be more resilient than many people anticipate.